The recent rise in the price of oil has sent Brent crude to four-year highs. In part, it's been driven by US sanctions on Iran. As a consequence, Saudi Arabia said last week it plans to raise production in November from its October output of 10.7 million barrels a day, which is the highest ever level of output from the country. Independent oil analyst and Forbes columnist Gaurav Sharma joins us now with some more analysis on this. We've coming into an interesting season, of course, for OPEC, but the back end of this year, OPEC has recently said that they can't stop oil rising to $100 a barrel. What's your view on where we are and where the price is likely to go?
I think right now the market is trading on sentiment, and I think there's a little bit of a disconnect between where the market sentiment is and where actually what physical traders are telling me. So I think the way I see it is OPEC is right to say that there is very little it can do, because if you recollect, in June they said, just to calm the markets, they said that they will nominally raise their production levels back to and bring their compliance back from what was something like 135 or 36% down to 100%. Basically, keep the levels that they stated that they would cut. Now, what can OPEC do? To quote the Saudi oil minister, the physical requirements of those who turn at the end of a pipeline to collect their cargo is being met. You know, all of Aramco's clients are satisfied, and that's just the Saudis. So the feedback from OPEC is that whatever they're exporting, it's in a complete connect with the physical markets. So would, on a whim or a couple of tweets from President Trump or some external pressure from the Americans, would they then try and wipe out their spare capacity? I think it's highly unlikely. All right, they might have an uptick of 100 or 200,000 barrels per day per member, or however it works out. But they don't want to wipe out their spare capacity because they see no reason to do that. What is happening right now is, quite frankly, of President Trump's own doing. Well, basically, he decided that he's going to unilaterally reimpose the sanctions on Iran. Well, he took a gamble to appeal to his base. Fair enough. But what that happens is that it gives the long callers an excuse to trade on sentiment. And then what happens is that impacts the sentiment. People think that Iran will probably result in about 1.4 to 1.5 million barrels per day once the sanctions really start to bite from November onwards, and I think that's a fair reflection around the city. So what's happened is that President Trump decided to do so. The market then got an excuse saying, well, let's trade on this sentiment. It may or may not connect with the physical markets, but you'll have a lot of long callers go in there, especially the hedge funds, see that let's get in there and let's see if we can try and extend the rally. When
we last spoke, I think you were talking year-end figures around about $75 a barrel. Is that still your call then?
Very much so, very much so. But then again, the average price probably would not resonate as much with the spread bettors on your terminal or elsewhere, because what spread bettors need to do is they need to trade on the news. Right now the sentiment is in favor of an uptick. We've got to breach 90 first before we even touch 100. That said, I don't think a medium-term price of $100 is sustainable, not even 90 for that matter. I think we're stuck in this average price of using Brent as a benchmark of about $75 for much of 2018. That said, if you're a paper trader, or if you're pacing a spread, take a 500-point spread out. Either ways, take a very careful eye on the news, because we don't know what President Trump might do. He might, for all intents and purposes, as is the rumor, might just wake up one morning and say the Americans are releasing as many million barrels from the strategic petroleum reserves. So again, that might not have a direct impact on the physical markets. In fact, it'll flood the market.
And of course, I think
affect the price.
I think there's also some news that the US administration is now even considering lifting the sanctions on Iran. So I mean, there's lots of, as you say, there's an ebb and flow of news going on here.
It's very tricky. It's very tricky. So you've got to be on your toes. You can be sort of medium-term long, but you've got to be on your toes, because we don't see where this is going. One moment President Trump was calling the leader of North Korea the rocket man, and now apparently they're about to have their second meeting. So this is the whole problem here. The policy is completely out of whack. And another thing here is, this particular president can afford to do so because American domestic production is so high. That has had a transformative impact on American foreign policy. America is on track to become the world's largest oil producer.
Right.
So even if the Chinese don't buy that oil, which is why I think the physical markets are in sync. So there is rumor, as you might have heard, that the Chinese are reducing their American imports to the point of zero. But the Indians aren't. And of the big five, India is the only economy that's actually importing more in relative terms to this very point last year. So there'll be takers for American barrels, there'll be takers for Saudi barrels, and for what it's worth, will the sanctions have an impact? The Chinese would demand a discount and probably can afford to take Iranian barrels.
What news flow are we going to get, do you think? We're coming up, as I said, to an interesting part of the season for OPEC, at least. We've got the OPEC monthly report out a little bit later on this week, and the big OPEC meeting, of course, I think in November, isn't it?
It's. I think there's a meeting of the OPEC plus, and then of course the ministers' meeting is on the 6th of December, if my memory serves me well. Yeah. And I think if you look at the sequence of events, I think you will very much see OPEC come out and urge a little bit of caution on the demand front. Now, global demand is somewhere just south, literally it's about 99.3 million barrels per day, the whole global demand. And I think there is a little bit of disconnect between OPEC forecast and EIA and IEA forecast. But I think on average, you can say that demand in 2019 would grow by 1.4 million barrels per day or thereabouts, 1.4 to 1.5. Now, let's say the worst case scenario where a lot of forecasters are predicting that Iran alone will take out that amount. Okay, so let's say that cancels out, the demand versus what Iran takes out. American production is rising. Canadian production has a bottleneck on how they export, but that's rising. There are a whole host of producers out there who are rising. And on top of that, President Trump is applying pressure on his allies, or whom he sees as his allies within OPEC, to up their game. So even if they nominally raise their production, I think Iran can be taken care of. And I think the Venezuelan decline is already priced in. So what we're having right now is a lot of people saying, well, you know what, Trump only has himself to blame for this uptick. And while this uptick is having, people can play it.
Okay, let's go back to the chart for Brent. I want to bring this up again because we're currently trading at 82.93. We're an hour or so before the start of Wall Street on Monday. Do you think that you're talking about your 75 barrel end of year target here? This dotted line is the 80. Do you think it's, from this point here, do you think it's more likely that we're going to go up to 100 before we hit 75 or 80, or do you see further downside? I don't want to put you too much on the spot because obviously day by day it could go in any direction, but do you think it's more likely that sentiment will continue to drive that rise?
If President Trump doesn't sort of interfere in volume terms, forget the tweets. If he wakes up, tomorrow morning or something like that and says, well, he's releasing the SPRs, then again, that will play down the sentiment. Well, we'll have to wait to see if 90 gets breached first. What we're seeing today is a lot of profit takers are in there because they think they've pushed the oil price as far as possible to about 84, 85. And they think now's the time to cash in on the positions. So that's why you see a little bit of a decline today, and we don't know what the president might do. But then as I see it, I'll see 90 being breached. It's very plausible. It's very, very plausible because we don't know where sentiment takes us. 90 being breached is very plausible, but I think 100 is stretching it. Maybe there are a lot of anecdotal evidence out there in the market that people see a $100 oil price, in Q1. But be careful what you wish for.
Yeah. Okay. All right. We'll leave it there. But thanks indeed for joining us, Gaurav Sharma, independent oil analyst and columnist for Forbes, taking a look there at the year-end price. His target remains at $75 a barrel for Brent.